I'm never going to invest another penny in the stock market. As a matter of fact, I stopped investing in the stock market in the year 2000 when it started to go down. Now, as we really look at this has become synonymous with investing. People think stocks. A few people think about real estate, but for the most part, we've been taught that when we save or invest, it should go into the stock market, that it's an investment in the future of our country, that it's an investment in the corporations. But as we start to dive in, how many of these corporations, A, would you even want to support? And B, is it really investing, or is it a lot more like speculation and gambling? Where else in your life would you go and do something that failed 9 out of 10 times? I've never got an airplane that's failing 9 out of 10 times, or a car for that matter. I wouldn't do anything that's failing 9 out of 10 times, and yet that's what we're being trained, taught, and educated when it comes to investing. I sat down with one of my clients, and he's a close friend of mine, and actually is a doctor of mine for the last 13 years. And as I'm talking to him, he's looking at potentially making an investment in the stock market. It was really measuring, should he pay off a loan, or should he invest in the stock market, or do something else? Now, he happens to own a business that he's recently expanded. He's brilliant at what he does. He adds massive value out there in the world with that. And so that's one option of where he could invest more money. Another option is, because the economy right now is fairly unstable, it's been growing for an extended period of time. It's the second longest period of time in U.S. history since we've had a recession. And so he feels it might be a little bit overvalued, and I tend to agree with him. Or he could put it in the stock market in companies he doesn't know, he doesn't own, he doesn't control, in hopes that they might have a return sometime in the future. Now, he's got people in his ear that are trying to sell him a product, which is a variable annuity, and that variable annuity can participate in the stock market, but there's certain fees associated with that, and by paying those fees, he gets some degree of guarantees, but those fees eat away a lot of the returns. In the world of investing, and especially retirement planning, we've been taught that we really should accumulate money, that we should set it aside, that we should be in there for the long haul. But the reality is, as we sit there and wait, we lose potential time value of money, where it could grow if it has losses. We don't understand the outcomes or the exit strategies a lot of times, like how do we actually benefit? When do we benefit? Why will it grow? Is this really the right thing to do for our money? And if we dive even a little bit deeper, here's another issue. What if there's companies out there that you would never go buy something from, or you don't even like what they're up to or what they're doing, or you might think completely different and against that? And at the same time, you might be funding that kind of a thing when you buy a mutual fund, which is going to be a collection of stocks, right? Or when you put your money in an index fund, which is less managed, and it's just what are the top 500 companies, for example, in the S&P 500 index. And as time goes on, you're hoping that it grows, but what if it doesn't grow at the rate that you were promised? Now, if we look at investors like Warren Buffett, see, Warren Buffett goes out there and he buys a company or he buys a stock, but now he owns the company because he's the major shareholder. He's got billions of dollars to allocate. He's got billions of dollars of cash right now, and he gets a 22% return year in and year out, because he does it completely different than the speculators, than the gamblers, than the rest of the world that is just handing their money over and hoping that it works out, because we have no control over what happens with the management team of that company. We don't walk in and command any degree of like, hey, this is what you need to do next, and if you don't, then you're fired. But that's something that he can do. He is more of a business owner than a traditional investor. He's not just putting money in a retirement plan, he's allocating enough cash that they can go implement their investment philosophy. And when they implement that philosophy, there's a lot to learn there. So let's look at that for a minute. They might go in and focus on how can they increase the value of this company. Therefore, increasing the value of the stock, they've got a degree of control, they've got a team that comes in, and when they implement that methodology, yes, those companies grow a lot of times because they put more on fewer people. My uncle actually worked for a company that Warren Buffett bought, and then his job as a VP basically became firing everyone. That was tiring to him. He's asking people to take on more work without more compensation because that's going to drive the price up. So shareholder value is where investors or even a CEO has a fiduciary responsibility. They're responsible for doing everything they can to increase the value of that stock, which might be putting a lot on workers. It might be cutting expenses and then adding that work to those individuals. It might even be that, that we're going out and doing things at the harm of the end user. We've seen this with Big Pharma, and there's documentaries out there where they would go and they would buy some company that had a patent on a life-saving important drug, and then they would jack the price up 5,000%. You heard about that maybe with the EpiPen or with other type of medication where people had rare diseases where if they didn't take it, they died. They went from maybe $1 a pill to spending $20 a pill or $50 a pill, and then you saw people that their entire bill for the whole year was hundreds of thousands of dollars for that life-saving pill because their life's important. They go do that. That's a shareholder value. That's not value creation of saying how does the company win and how does the end user win. That's a shareholder value that says how does the company win at the expense of the end user. That's against my value system. I'm not excited about that. And look, we have tons of retirement planners. They're not thinking about it at this level of depth. They're just looking at what did this investment do over the last 10 years? What is the track record of this investment manager? And because it's synonymous that investing equals putting money in stock, there's been enough marketing and social agreement that so many of us have just followed suit. Another reason I don't invest in the stock market, and I'll never invest in the stock market again, is there's a lot of misinformation. For one, let's say we've got average return versus actual return. Average return is not what you're actually experiencing, it's just doing math. And math and money don't always equal the same thing. So if I had 100 grand and I lose 10%, I'm all the way down to $90,000. Now, if I earn 10% and I turn on the news and they say, the market's rallied, it's come back, you've earned your 10% back, I only made 10% on $90,000, which means I'm not back to my original $100,000 investment, I'm at $99,000, $1,000 short. But wait, it gets even worse because they don't refund the fees they charge to manage that money. Right? Even if it's an index fund, there's some degree of fees. If it's inside of a retirement plan, there's also legal fees, admin fees, all sorts of additional fees on top of what you're paying for the funds. And so I might be down at $96,000 because of all the fees that have now come out of the plan. I don't like that type of a situation. I think the economy is too volatile to be risking my capital, and I don't like the notions of, dollar cost average. If you haven't heard of the dollar cost average term, all that's saying is put your money in every single month because sometimes the market's up, sometimes it's down, and you're going to buy at an average price if you just consistently put your money away. The mantra, invest early, often, and always. Right? Regardless of the outcome, if you're just patient enough, if you just ride it out, it should be okay in the long haul. But let's look, how many people are actually okay in the long haul? When you look at people that are investing their money that are older than you, or if you're a retiree and watching this, did it work out how you wanted? Interest rates have been so low for so long, that's been great for business owners and borrowing money. It's been kind of terrible for those people that are out there going, hey, I'm trying to earn interest for retirement income and be safe with my cash. So that's been part of the letdown. So if we look at Enron, this company that was a big-time energy company that you'd hear about all the time, it was just fabricating their numbers. They weren't creating actual value. They were lying in order to create false shareholder value. But as soon as everybody knew it was a lie, and once that was exposed, it went from being worth a bunch of money one day to being worth nothing overnight. Because when you're buying on the first end, right, on the IPO, when it first comes out, the initial public offering, there's a value that's set, and it either goes up or down from there. So you can determine whether you want to buy it. After that, you're buying it on the secondary market, either through a mutual fund or through that individual stock. You're buying from someone who's already bought it before, and that's only worth what people are willing to pay for it. Now, if all of a sudden they know it's a lie, they know it's a fraud, they're not willing to pay anything for it. It's only buying on the information that we have access to. And there's so much information out there. There's so many things happening. There's so many degrees removed from what's actually going on versus what's being reported on the news, and we're taking far too much risk. Now, if this was working, that would be one thing. But it's not. It's been a failed financial experiment, a failed financial system, and this is why we're not seeing people become more financially independent. This is why we're seeing people work so hard, take all that hard work and set capital aside in something they don't know or understand, which is highly speculative and risky, and then getting to the place where they don't have time for the money to grow anymore because now it's retirement time and they live a worse lifestyle than expected. That's not a retirement dream. It's a retirement nightmare. I'll give a second example on that. See, if you had $1,000 and you earn 100%, it grows to $2,000. That's awesome. But if the next year it loses 50%, 50% off of 2,000 takes you back to 1,000. That's a 0% rate of return. See, averages, that's like if this morning I decided to take a shower and I had two shower heads, one on my left and one on my right. I turned one freezing cold and the other one scalding hot. On average, I'm at a lukewarm temperature, but in reality, I'm miserable as hell. And so I want to help you to understand what's really going on with your money. Me, I'm not such a good stock market investor. I don't want to read about that every single day. I don't want to watch CNBC. I didn't even want to watch it before I went on to be a guest on CNBC. It's just not what I enjoy, hearing about that technical analysis every day. It doesn't enhance my quality of life. And before you're even allocating money to investing, and unfortunately maybe calling it saving, I think it's important to build 6 months of your savings and set this money aside so that when there is that inevitable surprise that happens in our life, it doesn't have to derail us, it doesn't have to destroy us, it doesn't have to become overly stressful. If you have double-digit interest rates, why not pay off that high interest rate and get that guaranteed savings, improve your cash flow, have less stress? That's another thing you can do. And invest first and always in yourself. What can you do to increase your skill set? Really determine your abilities. Add more value with everything you do. This is a different way of thinking about investing when you invest in you. When you invest in the things that you can do that add more value and give you more money. Dollars follow value. So how can you become a better value creator? How can you be more aligned with the things that you do with your money? We vote with our dollar every single day. So let's review a few things. Number one, saving is different than investing. Saving is setting money aside that's available, that you have access to, that's stable and secure. Not a big rate of return on that. If any, it's pretty negligible in today's world. Where investing is, you're allocating something maybe to create cash flow, maybe to create growth, but it's less predictable, probably a higher degree of risk overall. And because you don't know what those outcomes are, if the economy goes down, that investment might go down and that money might not be available to you. And if you're in a cash crunch because of the economy turning, you might have to liquidate that at a time where it's a lower value, and that is part of the problem here. So I stopped in 2000 when the market started to go down, and I couldn't explain how long it was going to go down, why it was going down, why these companies were valued at one thing one day and did have a totally different value the next day. I realized was more of a perception and a perspective than it was reality. I don't put money in the stock market because I don't have control over those companies when I buy those stocks. As a matter of fact, if I have 500 companies, I'm not reading all the reports. I'm not excited about everything that's going on inside of those boardrooms. I'm not sure how sustainable their initiatives are. I'm not sure what technology is coming out that could disrupt everything and make that company more obsolete. And so ultimately, I don't like to invest where I don't have knowledge. I call that more gambling than investing. And then when you look at it, and it's failing 9 out of 10 times, that Americans are getting to retirement, yet they're not able to retire off their retirement plans that are fueled primarily by the stock market, something is wrong here. You can go to wealthfactory.com/investing. You're going to find out things in this guide that I'm going to contribute to you on 7 ways to invest like an entrepreneur. That compound interest is not the miracle some say it is. You can figure out, should you pay off your mortgage early or not? And that really depends on who you are. How do you protect your investments so when the market goes down, you don't watch your money go down with it and leave your pocket and go into someone else's, because money's never lost, it's merely transferred. And then how can you be more productive by understanding whether you should invest to earn interest or whether you should pay something off to earn interest? Once again, that depends on you. And once you identify that formula, these are just a few of the resources. By the way, that's one of the 7 resources within this guide, wealthfactory.com/investing. I just want to bring this value to you. I want to help unveil what's really going on in the stock market, have you question, should you really be investing there? Is it a good investment for who you are? Do you trust in what's going to happen there? Do you support the companies that you're invested in? Do you know what's going on with those companies? And Warren Buffett versus us, that's very different. He's not just an investor, he's a business owner that does it through the acquisition of companies. Do you want to do that? Do you have a methodology? Do you have a team? Or would you be better off saving this money yourself? Building up the right stability, paying off things that are destroying your mindset or you're feeling really stressed about, whether that might be a student loan. And you really should look at other videos I've done to figure out what's the best way to pay off a loan if you choose to do that. And not all loans are debt, so be careful about just saying, I'm going to pay this off regardless, and I'm just going to scrimp and sacrifice and save, because that could put you in a scarcity mindset, and scarcity is the greatest destroyer of wealth.